Hey guys, and welcome back to another video. Today we're going to be having a look at Google's earnings and Disney's earnings. So I thought I'd start combining these videos together because I realized that there is too many companies that will be reporting earnings, and if I don't start combining earnings into one video or multiple earnings into one video, then all you're going to be seeing is earnings videos for the next 2 months. And I also have a ton of other content that I want to release, so I'm going to start to combine them together just to make it a little bit easier for you guys to get the information. As always, of course, if you have any companies that you want to see me make a video on talking about their earnings, and their earnings are coming out next week or the week after that, make sure that you leave them down in the comment section below, and make sure you leave a like if you do enjoy this one so that I know you guys want to see more earnings videos into the future. But for now, guys, let's jump into it. So we'll start off with Google, and Google this quarter was reporting their fourth quarter for the full year of 2018. So they came in with revenue of $39 billion, which was up 22% year over year, which is great to see that Google is still able to grow their earnings at such a fast rate. It's really impressive to see such a massive company of that scale still doing it, which is it's an excellent sign. Then we have net income, which was up. It was $8.9 billion, which was up from negative $3 billion in the same quarter last year. Now, last year, Google had a $9.9 billion tax hit, which was due to changes in the tax legislation. You may have heard me speak about it earlier in last year. And essentially, when there was changes in the legislation, Google was able to bring a ton of money back from overseas accounts into the United States. And as a result, they took a small one-time tax hit. Well, it wasn't small, it was $9.9 billion. But if we actually exclude that $9.9 billion tax hit from last quarter, we can do a fair comparison between how the company performed in the fourth quarter of 2017 compared to the fourth quarter of 2018, and how they performed. They were up 29% year over year, so very impressive profit growth. EPS came in at $12.77. We had free cash flow, which was $5.9 billion, which was about the same as it was in the fourth quarter of 2017. And the reason that it was the same and that it didn't grow was because capital expenditure in this quarter was a lot higher than what analysts and what investors were expecting. So analysts and investors were expecting a little over $5 billion in capital expenditure. And for the fourth quarter of 2018, they actually had $7 billion. And this is basically because they're investing aggressively in Google, in the Google component of the Alphabet business. They're investing aggressively into cloud data and building out their data centers so that they can expand their cloud business. So after the release came out, Google's earnings actually fell a little bit, and the reason can basically be attributed to a number of different things. The first thing that happened was that the cost per click went down. So the cost per click is basically how much an advertiser pays per ad. So if you don't know how the advertising system works, you should really look into it because it's quite fascinating. But basically, it's a bidding system. So the more competition there is for a particular ad spot, the higher that these companies have to bid up, and the more money that companies that are offering the space, like Google or Facebook or Amazon, the more money that they make. So in the quarter, or from year over year, the cost per click was actually down 29%. And essentially what that indicates is that there's less competition for Google ads. And what that tells us is that advertisers are either spending less on Google ads or they're looking elsewhere to put their advertisements. And it's likely that they're going to platforms like Amazon or Facebook in order to advertise more aggressively, probably because they're more effective. Facebook has a very effective targeting system, and Amazon allows business owners to advertise directly where people are searching for products. The second negative that adversely affected Google's stock price after the earnings came out was that traffic acquisition costs were up 15%. So what TAC is, it's basically the amount of money that Google pays to companies like Apple in order to be the default search engine. So Google is the default search engine on Apple products, and they have to pay Apple in order for that privilege. And that's called a traffic acquisition cost because essentially they put the search engine in the hands of users on Apple products and on other products, and that way they can get advertisers to advertise on their platform because every single person is using Google search. So that was up 15%, which was a surprise to analysts that it was up so much. And essentially investors and analysts have been expecting this TAC number to at least stop growing, so that there can be a greater margin appreciated from the difference between how much advertisers are paying and how much it's costing Google in order to acquire those advertisers. And the last thing I've got here is that margins actually fell to 21%. That's down from 23%. And again, this was just a surprise to analysts who were expecting 22%. So that brings us to the Walt Disney Company. So Walt Disney Company was actually reporting their first quarter of 2019. So different to Google. However, let's have a look at their numbers. So in terms of revenue was 15.3 billion, and that was unchanged from a year ago. Flat revenue growth isn't particularly surprising from a company like Disney. It's a slow growing company. It's a massive business in its industry. So that wasn't too much of a surprise to me or the analysts or investors. In terms of net income, it was 2.8 billion, which was down 37% year over year. Earnings per share came in at $1.86, which was down 36% year over year, and free cash flow was 904 million, which was down 28% year over year. And these declines, again, not surprising, because actually if we look at the first quarter of 2018, then they actually released two massive movies, and those movies did really well, unexpectedly well. And as a result, the comparison from the first quarter of 2018 doesn't look as good. Looks much better than the first quarter of 2019. So it makes it look like they did poorly in this quarter, but they didn't. It was just that the last quarter, or not the last quarter, but the first quarter of 2018 was an exceptionally good year. And lastly, in terms of the numbers, we've got equity, which was $54.4 billion, and that's up 3% from last year. Now, I've just got a couple of other notable things to sort of be aware of, and some things that the CEO, Bob Iger, mentioned in the conference call. So he mentioned that ESPN Plus, which is their streaming service for their sporting platform, that actually reached 2 million paid subscribers, and that's up from 1 million paid subscribers just 5 months ago. So they've been growing that rapidly, although that's still very small if you compare it to something like Netflix, which has over 150 million paying subscribers. Bob Iger said that direct-to-consumer services like their streaming services is going to continue to be the #1 priority for Disney. They now have Disney Plus, which is coming out later this year. They have ESPN Plus, which is already out. And through the Fox acquisition, they have controlling interest in Hulu, which is another streaming service. So that's going to be a big focus for Disney going into 2019. And it will, again, be interesting to see how Disney Plus competes against Netflix and see what happens and how it affects the market when it's introduced. Are a number of people going to get Disney Plus and keep their Netflix subscription, or are they going to cancel their Netflix subscription and get Disney Plus, or is Disney Plus going to be a complete flop and no one's going to be interested at all? That's going to be very interesting to see what happens. So I hope you guys enjoyed this one, and if you did, make sure you leave a like, and of course let me know what companies you want to see me talk about down in the comment section below. Subscribe if you enjoyed, but for now guys, I'll see you in the next one.